Thank you to everyone here and the organizers especially. I'm honored to present and to close off the conference. So this is a paper about asset-specific risk and return in real estate. The focus here really is on investment real estate. That means commercial real estate, income-producing real estate. Although I think a lot of what you see here, there are hints that it is applicable beyond the data to which I apply myself. So here's a diagram that I borrowed from my esteemed colleague Greg Brown here. Most of what we focus on in academics, in financial economics, is the public markets for securities. But in terms of global capital, the vast majority of global capital is invested privately. Of this, real estate, commercial real estate, so income-producing real estate, and I believe this is institutional quality stuff. So the kinds of things that your pension funds are going to be investing in, and all of you have some of this in your portfolio, whether you're investing in some kind of an index fund that has real estate investment trusts or otherwise. That comprises about 13% of all of this, and that's a very big number. It's huge. And yet, we don't really know a lot about the asset-specific risk and return profiles for these types of assets. And let me say, there's no lack of billion-dollar buildings out there. So, these are like small to medium-sized mid-caps. So why am I interested in the asset-specific nature of the risk? Should we just look at portfolios and indices? And I would say idiosyncratic risk in this space matters. And the reason is that a lot of investment-grade real estate is actually held by private individuals or families, so it's quite concentrated. It would be useful to have some kind of a way to assess the riskiness of these concentrated portfolios. Moreover, pretty much all real estate investments are underwritten at the property level. A lot of them have debt. Secured debt prices the idiosyncratic risk because you default very often because of an idiosyncratic shock. So it's important for that reason. But also, a lot of commercial real estate is managed by in small funds. Small funds, say several hundred million to a couple of billion. They'll only have maybe 10 to 20 properties in there. And there are managerial incentives that are going to be affected by the idiosyncratic risk, and we need to understand that in order to understand things like compensation contracts. So that's my spiel about that. What do we know about commercial real estate asset-specific risk? And an inspiration for this paper, when I started thinking about this a number of years ago, was an exercise undertaken by Downing, Stanton, and Wallace in the 2008 working paper, where they effectively backed out an implied volatility for the underlying assets from loans, and came up, if you subtract out what you might think would be the systematic risk in property markets, came out with an estimate of 20 to 24% property level risk for commercial real estate. That's huge when you think about how these types of assets are marketed as very smooth and not moving very much with the economy. And so I thought, I need to look at this more directly because that's kind of was a starting point for me. Another related paper is Zaplotzi-Torres and Volkanov in an RFS paper. They look really at geographic portfolios. So they're diversified within a single geography. You have a lot of properties, and they see that there is quite a bit of dispersion across geographies once you aggregate at the geography level. So that's kind of what I think what we know about this stuff. Most models that we have these days for looking at asset-specific risk, including things for modeling mortgages and mortgage-backed securities, as well as these econometric exercises, assume some kind of a diffusion price process. And this is really where I come in, because when I looked at the data, I couldn't square the data with this assumption of a diffusion process. I'm hoping to convince you that individual property prices do not appear to follow a pure diffusion process. There is a huge transaction risk component, maybe 2 to 3 times the annual diffusion risk, which is substantial. And it's quite important both when you're thinking about things like mortgages, options, instead of contracts, etc. And in order to understand that and measure it, what I do is I explicitly model transaction risk in an equilibrium setting using a random matching and bargaining type model. And interestingly, I get a really great fit to the data. So, and I can quantify transaction risk. So I can come up with transaction risk curves, which are basically probability of transacting given a reservation price, that's derived directly from the data. And in principle, you can take this type of model and extend it to other liquid assets. So, okay, let's talk about the econometrics and the empirical part first. So if you want to measure risk-return characteristics of properties directly, you have a problem because these things you can't do time series analysis. They just don't trade often enough. So all you have are holding period returns. And so here's the task. You're going to take holding period returns and going to try and back out from those holding period returns some kind of an underlying stochastic process so that you can assess the risk-return characteristics. The problem is that holding period returns are endogenous. People buy for a reason. And when you're looking at a holding period, there's a purchase and a subsequent price by the same entity. Okay, so this can distort the inference. Let me give you a quick example. If everybody followed the following rule, we'd be in trouble. Here's the rule. You purchase, you only ever sell if the property is a complete loser. What's that going to look like when you look at holding period returns? Every property is going to look like it's a loser. Investing in the property market is a bad thing if you only pay attention to holding period returns. There's an endogeneity problem here. So we have a joint hypothesis problem. In order to do an estimation from the data, you have to hypothesize some kind of an underlying stochastic process for the assets, but you also need a joint hypothesis. You need a second hypothesis for why people buy and sell. And then you estimate effectively the combination of the two. Let's do this. Let's do this in a way that I think would be natural, especially given the way that the literature has handled commercial real estate and its risk-return properties. Henceforth, when I talk about returns, I'm really talking about holding period excess returns of log price appreciation. So excess meaning in excess of a risk-free alternative. And I'm looking at price appreciation. I'm not looking at the income component. Quick reason why not. Properties throw off a lot of income. You cannot reinvest the income in that same property. You can't. And so if you choose to reinvest it in something else, that will and then create a total return out of that, you're going to distort the total return. It's not going to be reflective of only the property itself. It's going to be mixing in index returns or alternative asset returns. So I want to focus only on the asset itself. Price appreciation is the way to go. Here's my null hypothesis. I'm going to assume a diffusion. It could be a time-varying coefficient diffusion. That's fine. And I'm going to assume that the reason for selling or buying is unrelated to the underlying stochastic process. So that seems to be a natural starting point. I'm going to use data from the National Council of Real Estate Investment Fiduciaries. It runs from 1978 to 2013. This is data for repeat transactions. It includes also capital expenditures as well as partial sales. And I'm only going to consider NCREIF property index qualifying properties. What does that mean? That means that they're owned by tax-exempt entities, so there's no tax loss reasons for selling. They're generally stabilized properties with reasonably high occupancy, well-maintained in high-demand markets. So, okay. Holding period returns. Here is how you would model holding period returns using some kind of diffusion process. You'd have your holding period returns for the property. Tau is the holding period itself. There's some kind of an alpha. There's, again, this is price appreciation return, some kind of a beta times a systematic factor. And of course, there's some kind of residual component with a volatility. And this residual component, I'm going to assume, is uncorrelated across properties and serially uncorrelated. I want to remind you that you really only observe one holding period return per asset. And so now let's look at the null. Under the null, remember this tau is unrelated to the residual. So under the null, because this is a diffusion process, as we well know, in a diffusion process, the expected return and the variance scale. They're proportionate to the holding period. So this would be the structure. So this is a great candidate for testing or estimating with a regression using tau-dependent random coefficients and heteroscedastic residuals. There's a well-known approach for doing that, and I will essentially follow that. I am going to allow for differential year effects of these alphas. I will allow that because we know that these coefficients for the diffusions, they can experience time variation, so I will control for that. Okay. Let's see, for the benchmark systematic return, if this is, say, an office building, I'm going to use the office building index returns. If this is an apartment building, I'll use an index return corresponding to apartment building. So this is how I'm going to do this. And effectively, there are a series of well-known econometric techniques that employ structural GLS for random coefficients. I'll basically follow that. Details are in the paper. And here's what happens. The null is solidly rejected. If you model the average alpha in the econometric model, the null is right here in bold. But I find that there are these two components which are highly statistically significant for the alpha. So this is not behaving like a diffusion. Moreover, under the null, the variance should scale with a holding period. There should not be an intercept. The intercept is hugely significant. Here's an in-sample. Here are the in-sample predictions of the econometric model according to holding period. This is the expected return over here. These are the alphas. The alphas should scale. And notice here, first of all, it's not only nonlinear, the intercept is not even going to zero. It's going to something positive. Almost as if you make money if you just don't hold long in real estate. Well, there's got to be something wrong with that, and I'll show you why. In any case, so the null doesn't work here. If you were to now do a very naive exercise, this is a pretty sophisticated econometric estimation. If you were to do this really naively, basically group properties into holding period buckets. If a property that was held for 3.25 years, you put it in a 3-year bucket. If it was held for 3.75 years, you put it in the 4-year buckets. 3.5 years, you randomize, either put it in a 3-year bucket or 4-year bucket, and then you just do a regression holding the holding period constant. You would get something like this, superimposed on the more sophisticated econometric model. So doing something sophisticated, doing something simple, it doesn't matter. It ends up looking pretty much the same thing. So let's do it with the variance. I showed you the expected returns. They don't scale with the horizon. How about the variance? The variance looks kind of linear, but again, the intercept is non-zero. It's pretty clear. Do that same naive exercise, you get the same message. Okay. Importantly, this intercept here is basically 3 times, roughly 3 times larger than the annualized slope. So it's 2 to 3 times more variance that is not diffusion type than the annualized typical diffusion type variance. So this is important if you're trying to model things like option pricing, options embedded in mortgages, or things like compensation contracts. Excuse me. Okay, so robustness. How robust is this? I really, really, really tried hard to make this go away because I didn't believe this at first. So let me try and give you some compelling evidence why you should believe these empirical results. First of all, it turns out they also appear in other illiquid asset classes. For instance, in residential real estate, we knew about something similar to this, although it's kind of hidden in a bunch of papers by Case and Schiller and Getzman. Giacoletti, who's coming out of Stanford, Marco Giacoletti's coming out of Stanford on the job market this year. He's got a really nice job market paper that actually focuses on this very thing in the residential real estate market. So it's a little shout out in case you're interviewing him. We also see something very similar to this in private equity. We see that, again, there isn't a scaling with horizon for holding period returns for the variance or expected returns. Some authors interpret this as abnormal alphas for short holding horizons. I don't want to do that, and I'll show you why not. But the bottom line is that we see similar things in other asset classes that are only really related by how illiquid they are. I also did several alternative tests of the null. Same message coming across. You do alternative cuts on the data. Same things, same message. Suppose you only look at appraised holding period returns. It turns out the results, some of the results, the variance results disappear. Variance looks normal if you look at appraised returns. If you substitute the property returns, same data set, but substitute property returns with REIT returns, so public market, basically stock returns, real estate stock returns, all of these results disappear. So there's something transactional going on here. That's what I feel the message is. I also thought about, let's hold on to dear life to the diffusion hypothesis and just assume there's some kind of selection bias going on here. Kind of like what I gave you the example before. So I cooked up a bunch of stories. One is that just suppose that managers just like to hold safer assets longer. Anyways, the data is just not consistent with that story. How about optimal disposition? Kind of like what I told you before. You buy thinking this is a great property, you only sell if it's a loser. Or you buy if it's a great property, you only sell if it goes through the roof. Any of these combination of stories, that doesn't work either. It gives you counterfactual predictions. So we need something else. And that's where the model comes in. So I felt, given the evidence I've given you, that there's something transactional going on here. And in order to deal with that, I have to actually have a model for the transaction. So I need a model for repeat transaction in an illiquid market. Here are some of the assumptions. I'm going to assume that I have investor owners that are heterogeneous in their private values of properties. So different types of investors basically discount future cash flows at different rates. So I have a different discount rate than you do. That's the heterogeneity in private values. Our types move around in time. So the way I discount properties changes according to some kind of a stationary regular Markov process that's unrelated to other investors. So we all have our own private valuations that move around in time, but it's stationary so that the property doesn't end up only with high value types in some kind of a long-run equilibrium. I'm going to assume limited trading opportunities. What does that mean? Specifically, it means you can only entertain one bid per period. A period is a quarter here. Why does that make sense? In commercial real estate, as in residential real estate, but especially in commercial real estate, this is appropriate. You typically might receive several bids on your property, but you pick one. The one you pick, you sign a purchase agreement, and in that purchase agreement, there's a price, but a transaction doesn't actually take place until there's a due diligence period, which is really a way to renegotiate all kinds of things and investigate. And guess what? The seller can back out at any time at a very small cost. So the buyer can back out any time at a very small cost. So the seller is trapped over a single period of time with only one buyer. So I think that's pretty realistic. Transaction costs, of course. And I'm going also to assume, to make life easier, no capital or inventory constraints from the investors. So the investors can have as many properties as they want. Some people might worry, why is it that I'm using different discount rates across investors? Bottom line, it's more tractable. But you can think about that as reduced form for institutional liquidity constraints, capital constraints, individual beliefs or preferences of the property manager, portfolio effects that can be different across institutions, managerial constraints, agency concerns. There are lots of reasons why this thing could be fitting. Here's a timeline. Our property owner at time t sits there looking at future cash flows and discounts them at this rate. At time t plus 1, the property owner knows that they will receive this cash flow. The cash flow is very plain vanilla diffusion. Owner type can transition using the Markov transition rate to a different type. They receive a bid from a buyer, a prospective buyer, drawn from the unconditional distribution of investors. And then you either you either sell or you stay. So that's the timeline. Here's the kind of equation that results. Here's your value as an owner today, or as a prospective investor, but here's your value as an owner today, discounted future cash flows, here's a dividend, here's your value next period after you transition types. Here, this is important, this is the option value of someone coming along and paying you a higher price. Someone with a higher price coming along from the unconditional distribution, it exceeds your value by the transaction costs, which I assume here are proportional to the income. So here the transaction costs, as I said, are proportional to the income. This is the gains from trade. You split it with a prospective buyer. And that's what lambda does over here, okay? So, okay. Equilibrium is a solution to that set of equation. I'm going to think about an equilibrium steady state. That means that the distribution of ownership is not expected to change from one period to another. This way, I'm effectively not relying on any kind of degree of freedom type problem. This is, everything's going to be stationary here. Okay. If you conjecture the following price process, so the value is equal to the income times some kind of multiple. So this multiplier is basically your price to income ratio. You solve what is a kind of a pseudo-linear equation. The only place where private values are explicitly coming in is right here in the discount rate. This is the growth of income right there, mu. And bottom line is you can solve this. And once you have a solution to that, you can write down closed form expressions for holding period idiosyncratic returns. Here's what it would look like. You have to imagine somebody, type A, at day t, buying a property from some steady state owner. Already there's a selection going on here because only high value types will be able to afford to buy properties. Then this type A has to hold on to the property despite receiving multiple bids in the next t-1 periods, and then finally sell to some type B after having transitioned to a completely different type. At each step here, there's a selection criteria. You have to survive the bids. Someone has to come along with a higher value than you. There's a lot of endogeneity going on, and it leads to the following type of expression. Here, these two are standard diffusion components coming from the income dynamics. This is a normal shock multiplied by the square root of the holding period, very standard stuff. This is the Jensen's inequality term, proportional to the holding period. The unusual stuff comes from these two terms, the purchasing shock and the selling shock. And those shocks are what give you the extra variance that we saw before. But in addition, they can also explain the funny expected return, the high alphas at low holding periods. Why is that? How can you get a high alpha for short holding periods? The intuition is the following. When you buy a property, generally speaking, you have to have a high value. Otherwise, you can't buy a property from somebody else. Well, the only reason you'll ever sell after a short period of time is if somebody with an even higher value comes along. If your types are persistent, then what happens is that your value didn't change. It's just that somebody with a much higher value happened to come along. So you got lucky. The only reason you ever see short holds is because you see the lucky ones. And that's why it looks like they have high alphas. Okay. How long do I have? 5 minutes. Okay, so now let's see if we can fit this to the data. I'm going to use 11 states. Why 11? I want enough states to give me enough of a curve so I can fit something that looks semi-realistic. The Markov process is going to be basically a discretized random walk on a finite interval with reflective barriers. So it's going to be very standard stuff. There's going to be a single reversion parameter to this, which is going to be x. Small x means high persistence, and it turns out that when you estimate the model, you need very high persistence. I need also to model the distribution of discount rates for each state. That's 11 degrees of freedom. That's too many. I want to reduce this to 3. I have a high discount factor, I have a low discount factor, and then I can distribute the discount factors linearly or convex or concavely using this third parameter here, v. So I have 3 more parameters other than x. It turns out this is very hard to identify using the moments that I try to fit. So I'm just going to fix it at 1/2. Lambda, that's how we distribute the gains from trade. That's just going to be a fair coin. If there's a reason for us to trade, let's flip a coin. Either you get everything or I get all the gains from trade. The remaining parameters are the cost, the proportional cost, and the idiosyncratic property income volatility. That's a total of 5 degrees of freedom. And I'm going to fit this to 9 moments from the data. So this is highly constrained. Here are the moments for the data. I can calculate everything here. I can calculate in the model. So the quarterly turnover, point estimate, standard deviation on the point estimate. Here's the model. Average transaction costs, similar thing. Acquisition cap rate. Cap rates in real estate mean income to price ratio. So the average income to price ratio annualizes 7% of the data. I can fit directly to that. Fraction of properties sold within 5 years. Notice these are all within 1 standard deviation. Point estimates from the data within 1 standard deviation of the model. Then I have the actual holding period return statistics. I have two variance, 1 year and 8 year variances, idiosyncratic variances I'm trying to fit. Why 2? Because remember, when you look at the pictures, it looks like a linear equation. Basically, a slope and an intercept. So I want 2. For the expected returns, it was nonlinear. So I'll take 3 for those. And I'll fit 3 expected returns from 1, 6, and 8 years, idiosyncratic adjusted returns. Here's what it looks like when you graph against the estimates from the econometric model. So data, blue diamonds. These are the expected returns from the experiment, from the estimated econometric model. Basically, this fit is good enough you cannot reject that the actual truth is the model. Here's what the variance looks like. Now, what can you do with all this? So great, I fit this model. I think I understand now risk and return attributes for commercial real estate properties. What can I do with this? Well, the model's informative about things like the distribution of ownership. Over 50% of the owners in the steady state are the highest value types. And notice ownership is really concentrated in high valuation types. You kind of expect that, but it has implications. These guys here will never sell, or at least while they're high valuation. Remember, valuations are very persistent, so they're not going to contract with anybody. All the transactions you're going to see are going to be around here. That means that transaction-based indices will always understate the total value of the property market to the entire group of owners. Here is another thing you can do with this. This is a curve of transaction risk. Transaction risk I define as you have a reservation cap rate. Remember, cap rate is the income to price ratio. So high prices are here, low prices are there. This over here, the step function, think of that as a liquid asset. A liquid asset that whose income to price ratio is the same thing as that of the property market's about 7% of the data. This is what it looks like. Basically, for a liquid asset, if you get if you get an offer, let's see, did I get this wrong over here? Reservation. I think I've got this flipped. So yeah, I think the step function should go the other way. Sorry about that. If you get an offer at a very high price, you'll immediately sell. If you get a low price offer, you'll never sell. It looks just like for the property markets, it's extremely left skewed. This is transaction risk. Your chances of transacting are really low over here. In order to get security of transaction within 1 quarter, you have to basically take a big discount. This is a graph I really like. It's basically the time on market. This, the dashed and the solid line. Solid line is the mean time on market in years. This is median time on market in years. Here's your reservation cap rate. If you would not accept an offer below, if you would not accept an offer, say below this average transaction price, you'll have to wait a couple of years. But you will expect a really good transaction price because your reservation is high. You just have to wait longer. Here's a really neat thing. Suppose you wanted to have an expected transaction of whatever we see in the market, which is about 7. That means your reservation cap rate has to be about 8.2%. But it also means that you can expect to transact within a year. I don't have time on market data, but CoStar does. Here's time on market data. On average, it's a year. So the data, I mean, this model can tell us things even beyond just the fit that I gave you. Here's a graph of price of immediacy. If you absolutely had to sell within 1 quarter, here's the expected discount you'll have to take relative to prevailing market prices. It's about 20%. So if you're a bank, fire sale, about 20%. That's the estimate over here. I don't think it's completely off base. Here's another neat thing. In order to not have any discount in expectation for your need for immediacy, you have to have a buffer of about 3 years. Closed-end funds, which have to liquidate within a final date, will often have extension options. Guess how long those extension options are typically? Answer, 2 to 4 years. That makes a lot of sense. Anyways, I'm out of time. There's a lot more I can say, so I won't. And in summary, risk-return properties of commercial real estate assets, not a diffusion. You need a model, structural model of illiquidity in order to understand what's going on.